Aulfat, and I'm the head of the capital allowances team here at Innovation for Business. And I'm going to talk to you a little bit about capital allowances in respect of commercial property with a post-budget update. So for those of you who have come across capital allowances, they are a way of obtaining tax relief on certain types of capital expenditure that's been incurred on properties. It's typically on business assets and fixtures that's within the properties that are acquired or constructed or developed. For your purposes, we'll be looking at those properties that are being acquired. We'll have a look at the fixtures within the context of commercial properties only, whereby there's been an acquisition or a sale. So in terms of your basics, what are capital allowances? Where do they come from? They are a legislated form of tax relief. We've got the Capital Allowances Act 2001, but there's a whole plethora of case law, which means that it's not completely black and white and there's a lot of grey areas. The way that capital allowances work for taxpayers are when you're trying to calculate your profits that you will pay tax upon, you have to add depreciation on buildings and assets back, which makes you have a bigger profit. So in order to give tax relief on those types of depreciation, what you can do is get capital allowances, but you don't get it on all properties. You get it on certain fixtures within the properties. So effectively, capital allowances reduce your profits that are chargeable to tax. So they give you a bit of a tax depreciation. You can also view them as being akin to a deductible expense on certain types of capital expenditure. They enable taxpayers to write off the cost of an asset that they have acquired over a certain period of time. Sometimes it can be immediate in the year that they've bought the asset. Other times it can be over a slower period of time. The key thing with capital allowances are they aren't automatic. If you don't make a claim in a tax return, you won't benefit. So every capital allowances claim must be made in order for the tax relief to be given. In terms of who can claim capital allowances, it's basically UK taxpayers, but it's also relevant if clients are loss making because it will help to push out their loss making position a little bit further up until when they will become tax paying. Companies and individuals, partnerships, LLPs, you name it, anyone that's within the charge to UK corporation tax or income tax can claim capital allowances, albeit with certain types of entities or structures, there might be restrictions on the types of allowances that you can obtain. I would typically say the clients that we look are owners of properties. So that's your landlords, your tenants, your owner occupiers. So when I was talking about commercial property, the key thing there is it's commercial in a tax sense. So sometimes you can have some properties that are residential from if you were to look at them, but they could be used commercially. An example of that would be a care home, for example, or an assisted or supported living facility. Whilst they're residential for all intents and purposes, if they are used commercially, you can claim capital allowances on those properties. Also, communal areas within residential apartment blocks or misused apartment blocks, they are classed as being commercial, so you can claim capital allowances on the communal parts. And similarly, if you've got things like student accommodation as well, you can claim capital allowances on the communal parts to student accommodation. A key thing is that the property has to be held on the balance sheet, so it needs to be a capital asset. It's not trading stock or held on revenue account, and that property needs to be what's referred to as being in qualifying use. And this can be either used in the trade, it can be used for property rental purposes, as an office or a vacation, and there's a few other qualifying activities as well. In order to claim capital allowances on property acquisitions, the buyer or the claimant has to prove that they have entitlement, and that is a really important thing that needs to be done before a claim can be made. Thought I'd give you a bit of an overview as to what you can claim capital allowances on. So as I've mentioned, acquisition of properties in respect to fixtures, construction of property, if you are incurring any expenditure on extending, developing, converting or fitting out an existing building, and also leasehold improvements to a rented property. So if you've gone into a new office and you need to do a fit out, you will be able to claim capital allowances on your fit out costs. You can get a capital allowances as mentioned on certain fixtures. So they are typically your mechanical and electrical installation, so your lighting, wiring, power, heating, ventilation, aircon, and so forth, but also on your fitted fixtures and fittings. So things like your sanitary ware, your kitchen fittings, if you've got any shelving, etc. As I said, it's quite wide ranging and there is a lot of case law in terms of what can qualify. Sometimes things might qualify in one scenario or one type of building, but they won't in another. In terms of offices, in terms of property, you can claim it on anything from offices to care homes to communal areas to prisons, etc., as long as you meet the criteria. You can also claim it on furnished holiday lets. However, this will be abolished from the 5th of April 2025. So the relevance of capital allowances on commercial property transactions are, since 2014, the law changed, which meant that if a vendor could have claimed capital allowances and either they haven't or they haven't utilised all the allowances, the only way a buyer can obtain those allowances is if they enter into what's called a Section 118 election. If the Section 118 election isn't done, it's quite likely it'll be difficult to obtain those allowances. You do have a whole section, I think it's question 34 of your CPSEs, that are dedicated to capital allowances, but I can say hands down, I have very rarely seen them filled in properly. And I think the issue there can be, as solicitors, you pass that back to your client, ask them to get in touch with their accountant or their tax advisor. They go to their accountant, who probably only does basic accounts and maybe tax return for them, and they aren't filled in very well. And therefore, capital allowances can be lost in transactions or not dealt with properly. What I like to do is make sure that I'm at the forefront of when property transactions are going through, and make sure that we can write some clauses into the sale and purchase contract to enable the capital allowances to be passed over correctly post completion. If you don't have those clauses in the contract, there's no chance that a vendor post contract will enter into an election to pass over any allowances that they haven't benefited from, because it's not in their interest to do so. Whilst we're talking about actual asset transactions, if you have any share sales where you've got property assets, capital allowances are also important as well. There's very different rules that can apply, but you would typically step into the shoes of the current company and you could have a look and say, have they maximised their allowances, and what are the tax attributes in respect of the capital allowances. So it's quite important to have a review where you are doing anything in respect of a share sale to see, have the capital allowance been maximised? Has there been an overclaim? Are there any risks that you need to make your client aware of? And the other bit I'd like to highlight is where you're dealing with landlord and tenant contributions. There will be a capital allowances aspect to those, and depending on the way that the contribution agreement is written, it can impact who can claim the capital allowances. So it's quite important where you are doing contributions that they are reviewed accurately and the client is aware of whether they can claim the capital allowances or not, and if they can't, if they're happy to give those up to either the landlord or the tenant. In terms of opportunities, I'm going to just go over two. One will be vendor pooling and one will be integral features uplift. So a vendor pooling claim is where there's been a sale of a property. The vendor was entitled to claim capital allowances but hasn't claimed any or hasn't maximised them, and the buyer wants to claim those allowances. The only way you can do it, as I mentioned previously, is by a Section 118 election. But in that instance, the vendor hasn't benefited from those allowances, that they don't want to incur the cost of producing a capital allowances report in order to quantify the numbers that would go into the Section 118 election. So as a buyer, they're able to quantify those allowances on behalf of the vendor, obviously with their agreement, and then either they can do this either before you complete or post completion, depending on the length of time that you have. Where it's pre-completion, you'd need to ensure that there are clauses in the contract to ensure that the vendor facilitates this in terms of providing information that will enable the buyer to quantify the vendor's capital allowances expenditure once this is done. They need to also enter into the election and also pool the capital allowances that are identified, which means they have to make an amendment to their tax return as well. So there's quite a lot of steps, which means that it can be seen as quite onerous in order to do the vendor pooling claims. And often I would say capital allowances advisors probably try to shy away from advising on vendor pooling claims because they're a little bit complicated, but your client should know that there is this potential opportunity, and then it's up to them to decide whether or not they want to go ahead with it and proceed. The other opportunity is an integral features uplift claim. So again, it's where there's been a sale of a property. However, in this instance, if we can establish that the vendor has owned the property prior to April 2008, That's a key date because the integral features regime was introduced in April 2008. And that means that if you owned the property pre-April '08, you couldn't claim capital allowances on certain categories of integral features. However, a new buyer can. You don't need to enter into Section 198 election in this respect, and this can be done post completion at any point in time as well. So this is quite a nice way for you to sometimes have a sense check of what's happening on the transaction with the client and advise them that there could be some capital allowances they can claim post completion. And you will have the information to hand. You will know when the vendors acquired the property. So I think it's worth making sure that you're aware of the two different types of claim, the vendor pooling and also the integral features. I thought it'd be useful just to give a bit of an oversight as to what the methodology is for a capital allowances claim. I have come across some, advisors or, clients that might think you just apply a percentage. So whilst I can give a proposal based upon a percentage or an average of what I think capital allowances could be for a particular property, that isn't the way that you actually prepare a report. The guidance is very clear that you have to produce a report for every property acquisition where capital allowances are claimed. And technically, this is meant to be passed on to the Valuation Office Agency by HMRC. It might not always be done, but that's the way. So they're meant to review it. The way that we do this is, first of all, we establish that that the buyer can claim capital allowances. The onus is on the buyer to do this. We need to check if any potential abolished allowances could have been claimed historically, which I have noticed some more recent advisors don't actually do anymore. So you did have historically things like industrial buildings allowances, hotel buildings allowances, and agricultural buildings allowances, which meant that you could claim capital allowances on the entire building, not just the fixtures. If that's the case, any new buyer cannot claim any capital allowances on that building. Once you've established entitlement, we do what's referred to as a just and reasonable apportionment of the purchase price. This effectively allocates the purchase price between three parts. That is the plant and machinery fixtures, so the bits that qualify for capital allowances, and then the non-qualifying elements of the building, such as your walls, your floors, your ceilings, etc. And then we also undertake a bare site valuation, which is a tax calculation that goes into a formula. We utilize quantity surveying techniques, architects and builders rates, and we do comparable or residual land valuation calculations. This is inputted in a formula as per the guidance for the Valuation Office Agency, and then that will calculate what the capital allowances are. And we produce a report, a fairly chunky report that documents all of this. As I said, you can't do it on a percentage basis, and it's something that needs to be done in order to claim the capital allowances. So in terms of recent changes, we've had a few budgets that did focus on capital allowances. The most sort of pressing change that has happened is that from the 6th of April 2025, the furnished holiday let regime will be abolished. And with that, the capital allowances benefits of having a furnished holiday let will disappear. However, we are advising all of our clients to claim any capital allowances or unused capital allowances prior to the abolition date. You also have 2 years from to amend a tax return. So you can still do it after the 6th of April 2025, but you must be amending a tax return that spans that period. If there are any unused allowances that have been claimed, you don't lose them. You can just carry them forward and against any future property rental income. The other bits that have been changed was there was a super deduction that was launched during the COVID period. That's been replaced permanently by 100% full expensing for certain types of capital allowances, and there's no restriction on the expenditure that you can claim as full expensing. The annual investment allowance as well, which gives 100% first year deductions for the first £1 million of plant and machinery expenditure, has effectively been permanently extended as well. There's also been a focus on the Freeport tax sites, which have enhanced capital allowances benefits, and they've been extended until September 2023. Previously, they were for 5 years, but now they're up to 10 years. And then there's been an extension of the first year allowances, which are given at 100% for electric and zero emission cars. The other thing as well, it's sort of connected to capital allowances, but not completely, is there is a consultation that will happen in spring 2025 in respect of land remediation relief. And I guess the other thing to focus on is that corporation tax rate has increased, but it'll be capped at 25%. So with that, I'm just going to draw to close the presentation. And if there is any questions, I'd be happy to take those as well.
Perfect. Thank you so much. I'm going to join you back on the stage. Just leave it open to see if there are going to be any questions. So just to let everybody else know as well, just while we wait for some questions, Information for Business, IFAB, are running some webinars on behalf of quality solicitors. They cover all types of tax advice. They've already done one webinar on the SDLT tax reliefs, and then today obviously covered capital allowance. There is another one scheduled on land remediation relief, and there will be a further SDLT tax relief as well. Also, just on this, it's a very complicated area, and so we made this partnership, I guess, in terms of allowing our firms to be risk-free in having an assessment. So the process is relatively simple. If you identify anything that you think may fall into these areas, you're not going to be the advisor. The relationship then falls over to IFAB and the client, and any costs are against the client, and only if any reliefs or reductions are realised. So we have circulated information about the offering before, but again, if anybody wants a refresh of this, wants to arrange a one-to-one meeting with IFAB, then we can arrange that as well. So I can't say that there are any questions. It's been a bit quiet in the questions and comments section today. So if anybody does have anything after the summit, then please send them over to us and we can put you in contact with the relevant people. So we are due to go for a break looking at the agenda. So we're kind of running on time actually, so we can take that break now. The next speaker will be on after the break at 2:35, and we'll start promptly. So thank you again for attending and presenting to us. And like I say, if we have any questions, then we'll pass those on to you.
Great, brilliant. Thank you. Bye.